All right, this one's for the veterans out there. I want to bring up a scenario that came up in the office here just a little bit ago, and I think it's really important to kind of explain to veterans, or at least share with you, because I think it's a miss by a lot of people. Now, here's the thing. I had a veteran who had picked up a loan many years ago, back in, I think, early 2020, and the interest rate was incredibly low. It was in the twos, has a ton of equity in that property. And he was kind of looking at it and saying, look, I think this home is great, but it doesn't really make sense for me in the long run. Should I potentially sell this house, move the equity over to a new one? And the borrowing costs are so expensive, the rates are so expensive, I hate to get rid of this. So he's been stuck in this home, at least for the last year when it really didn't fit him. Now, the new financing terms are going to be somewhere in the sixes or sevens for this veteran. And so it was really hard to make that move to give up that low, 2% mortgage and move into the sixes or sevens. But we took a look at what it would be if he was to convert it into a rental. See, with that interest rate being so incredibly low, we actually had a really good opportunity to create some cash flow because the market rents in that area were really strong. So with market rents being really strong and a low mortgage rate, there was some cash flow opportunity there. The problem is, he didn't really have a whole lot of extra money in savings to go put down on a new house. He really wanted to borrow the money on this existing home. But as a veteran, there was bonus entitlement. So moving from that home, we had a certain amount of entitlement that was attached to that specific home, and the new property in the new area, the price point he was looking at, had enough bonus entitlement that he could actually go in with zero down. So he could leave that loan completely alone, buy another one using his VA with zero down. Now he's got two properties, one of them in the twos, and we don't want to touch that interest rate if we don't have to. The other one's probably going to be in the sixes or sevens. But blended across all of the money, if we look at it, was somewhere in the fives, and really, all in all, wasn't that bad. But there's a couple of really cool things that happen here. We have cash flow. The cash flow on that property, assuming the tenant is going to make their payments on time. Good vetting will ensure that that happens, so we can talk more about that another time. But the cash flow on that was really going to help offset the new higher costs that he was looking at for the new move-up property. The other thing is, if you look at his current taxes, the interest on the existing loan, because it's such a low interest rate, there was no interest write-off. In other words, the interest that was accrued throughout the year, because the interest rate was so low on his existing home, was far below the standard deduction. So there really wasn't a benefit from an interest write-off perspective on the taxes. But when you convert it to a rental property, you get to write off the interest, regardless of how much it stacks up. It's still a low amount, but you still get to write that off. On top of that, you get to write off depreciation, and you get the appreciation of the home continuing to go up in value because that area was still very strong. And on top of that, a portion of that minimum monthly payment that's being paid is knocking down the principal. So you're getting somebody doing principal reduction, you're seeing the appreciation over time, you're writing off depreciation, you're writing off mortgage interest. Cash flow is kind of helping offset the new property. And later, if you want to, you could sell that other property, take that big pile of money and kind of wipe out or knock down this debt in the future. Maybe rates are lower and it makes sense at that point to do, but I think he's going to find that it's actually really nice to hold on to that property for as long as he possibly can as he gets comfortable in this new house. So we were able to accomplish something that he initially didn't think was going to work out, but he made a phone call. We ran through the numbers and we decided it made sense for him to make the move. Over the last couple of years, he's got some income increase and that sort of thing. So it's actually going to make it a little bit more comfortable for him to make this move up. He didn't realize all the additional little benefits to creating that property as a rental. And on top of it, he was concerned he couldn't make it happen because he didn't have the savings, but didn't realize that he had enough bonus entitlement in the county he was looking at for the new VA loan to go 100% financing. So it never hurts to have a conversation on something like this. I think it's really important to look at it. When we run the numbers on it, we start to kind of play it out, we can find out if it works or it doesn't work. It becomes very, very clear, and it really doesn't cost you anything other than some time and some conversation to find out if it works for you. Let me know if there's any way we can help for you guys, but just wanted to share this story with you because I think it's super impactful, and a lot of veterans are missing the benefit of this right now.